All right, well, let's welcome in our market master, Rahul Arora, is CEO of Nirmal Bang Equities. He's with us right here. Rahul, great to have you with us here. Good morning. Thanks very much. How are things looking? And let's start with Ola, and if you have a view. Almost 50% in today, the third day in its listed life. What do you make of it? Have you do you have coverage, first of all? And yeah, thoughts?
So, morning. Thank you for having me on the show. And I think at least from a market perspective, Prashant, it takes me back to a line that Nawazuddin Siddiqui said in Sacred Games, "Kabhi kabhi lagta hai aapun hi bhagwan hai." You know, it just seems like nothing can break the market at all. You thought, you know, Fed rate hikes would break the market, wars would break the market, crude would break it. You know, the BJP losing elections would break it, long-term capital gains tax would break it. Nothing has broken this market. So the question some investors ask is, ab tak nahi toota, to ab kyun tootega? So that, I think, at some level is smacking of complacency. It may come out of nowhere, as you saw with the yen carry trade incident, but that also got bought into. I think that has shocked me more than the shocks that would come from Ola Electric, you know. But too early to make a comment.
By the way, even with Ola, some were saying at the margin that, you know, the historical relation, very large IPOs and what markets do when you got, you know, it just got absorbed.
I think those days of DLF and Reliance Petroleum are long gone, Prashant. I think that the markets were much shallower then, you know. But I think specifically on Ola, not a comment yet because it's just listed. We haven't really penciled in. Obviously, it's going to be something that we do track, but I think pockets of the market, there is a huge amount of sector rotation that's taking place. There's no question about that. But I think after each of these 4 or 5 incidents that I spoke about, whether it was the election results or LTCG or the yen carry trade, I think at various points value has certainly emerged. The market was getting very excessive at certain points in time. You were discussing certain defense names. It's heartening to see that they're coming off because things had become very irrational. But at an aggregate level, I'd still say if you were to look at the Nifty earnings projections for the next 2 years in terms of growth, because I think most of the margin expansion is done, Prashant. The focus is now going to be on the top line. So you're probably going to be looking at about a 13-15% kind of earnings growth for the Nifty between 24 reported and 26 actual. I think that should be your expectation for the market return as well. I think people should not lose sight of the fact that the Nifty was 7,500 not too long back, and it's more than tripled in a matter of 4 years. So I think at some level it's going to rationalize. The bond markets will come into play at some point with the inflation numbers yesterday, and I think the Fed talking about rate cuts will be interesting to see how the back end of the year, you know, comes up with respect to the 10-year. But I think that could potentially be a play as well. So I wouldn't be very gung-ho at this point in time. I think earnings expectations is what's going to sort of drive market expectations, but have reasonable expectation of about 13 to 15% kind of returns compounded over a 5-year period. And I think that will probably be in line with what your EPS growth will be.
Rahul, I'm just thinking Sacred Games also had another line, right? Sirf Tiwari bachega. So I think in the global market context, we all know which market is a Tiwari over here. But to go back to your point, I mean, since you are not very gung-ho and there is sector rotation, what do you incrementally buy? I mean, I know the argument gets made on FMCG every time, and every time there's a scare in the market, you'll see a little bit of a gravitation towards that side, but it's not building up in any sustained way. Because if you're talking about top-line growth, then we all know, I mean, right now, I think the best in case is being sort of a mid-single-digit kind of a number is what you can get. So should one be looking beyond this and go where others have not gone in the last 2 years? Or how do you play the market?
No, so I think the easiest call is BFSI. I think about 3 weeks back when we were doing Editors Roundtable, we did a piece on insurance companies as well. But I think overall BFSI is still presenting value. As I was telling Prashant a little while back, I think once we get into a rate cut cycle, I think you know, you'll probably get into a situation where the incremental fight for deposits on the rate front will abate. So I think pressures on NIMs will ease. You guys were discussing HDFC Bank at market open. They showed a 3 basis points sequential improvement in their net interest margin. SBI's valuations still look very attractive. I mean, for an 18% ROE, banks still come into at 1.5 times book. Bank of Baroda, although missed estimates, is trading at under book. And I think if you looked at, I just go back to another stock that Prashant was highlighting in LIC, just look at the insurance numbers yesterday. Look at what the private sector has done on individual APE and group APE, including the new business premium. I think 25 to 40% growth for all the large companies, including Max Life, which is predominantly a mid-cap. I don't think valuations are out of whack. I think 2 times price to embedded value for iPro Life and SBI Life, you know, what, 1.3, 1.4 for Max. And I think housing finance companies could be interesting. LIC Housing Finance was a miss this quarter in terms of results. But we like that space. We recently initiated on Housing Urban Development Company, HUDCO. We like that name. So I think BFSI valuations are not demanding at all. IndusInd Bank again coming to you at 1.5 times, Axis at 2. It's a clear overweight sector for us. Consumer Surabhi, not really. As you rightly pointed out, 50 plus P for most of these stocks for a 3 to 5%. And let's not forget, Surabhi, if you juxtapose V-Mart's results to this, you'll understand that there was probably an election play here. So that volume number that you're seeing of maybe 3%, 5%, even 8% in the cases of, say, like a Godrej, for example, I don't know how sustainable these numbers are. So to be paying 50 Ps right now for these, I'm not sure. I think FMCG has had a good run. Most of the stocks are up 25, 30% from the May results. At these prices, I would be tempted to play banks as a clear overweight, and maybe cement could be the other overweight blanket sector that we play.
By the way, I just want to clarify, our producer, Mr. Tiwari, has pointed out the line was not Tiwari bachega, it was Trivedi bachega. So just clarifying and, you know.
All right, Rahul, let's take that discussion forward then. Since you briefly mentioned cement, what do you like out there? The large are getting larger. You know, there was this time when everyone wants to buy the stocks that are at a big discount to the EV per ton. But if you look at actually the larger players, UltraTech Cement has been one of the biggest outperformers. What's the view? How do you approach the space?
So I think, Nigel, consolidation is going to be the name of the game when you're looking forward. I think there are eventually going to be 5 or 6 major players that stand. One is, of course, going to be Adani. The other will be UltraTech. Dalmia will be one, Shree Cement, and I think you'll probably have some consolidation in and around the JK group, maybe Ramco. So I think everything else will probably get subsumed into these 6 in one way, shape or form. I think given the fact that crude has been stable for a very, very large period of time, broadly between 75 to 85, and I think if you look at coking coal and pet coal prices, they've been off from the highs that we have seen by almost 25 to 35% from the peak that we saw. I think that there is a case if volume growth was to, of course, it's not been that good yet, but if you get into a situation towards the back end of the year post-monsoons where you have 8%, 9%, maybe even 10% volume growth for some companies on a weak base, then you could look at a play at EBITDA per metric ton going to about 1,000 or maybe even higher than that in some cases. I think if you look at ACC Ambuja combined, which is eventually the reality, it's going to happen at some stage. I think that looks like an interesting bet from the large cap space.
Okay.
I think if you look at the mid cap space, we like Ramco. I think there is still at least another 20% game that's probably left there. And JK Lakshmi from the small cap. So if I was probably taking one, to answer your specific question, one large, mid and small cap, it'll probably be the ACC Ambuja combined in the large cap, Ramco in the mid and JK Lakshmi. Birla Corp has had a good run. You know, the Mukutban facility is up and running. I think that could be an interesting dark horse as well. So let's not forget the first order the Prime Minister signed when he took office for the 3rd time was a housing order. So I think that is going to have a second order impact on cement demand. And I think especially in the case of ACC Ambuja, there's a lot of backward integration, railway sidings, etc., which I'm sure is well spoken about. So I think these would probably be the 3 top ideas in cement at this point.
Ramco is going to be interesting, right? Because suddenly you have a lot more competition in South India. Some of those plants that were functioning at almost zilch, you know, they're going to be ramped up. So it'll be an interesting play, though the stock has come off a little bit from the top. But we take that point. Since we mentioned real estate, what do you like out there? Just take a look at some of these stocks. I mean, we had some debate whether or not the tinkering in taxation was good or bad. The stocks, but I've seen a big recovery post that budget, eh?
Well, there was obviously, to be fair to the finance minister, that clarification that came in. So I think to that extent it was all right. But I think, Nigel, incrementally from here, I think commercial and retail look relatively more interesting than residential because, you know, I think there's been a huge run up in real estate stocks and demand. I think, you know, whether you were a DLF who picked up $1 billion in a weekend or at the bottom of the pyramid, you know, some NCR developers, some unlisted ones who I don't want to name, have picked up 300-400 crores in a weekend when they've launched. So I think that kind of demand is a little unsustainable, to be very honest.
Okay.
You know, you could look at names like Phoenix Mills. I understand St. Regis's results were not all that hot for the quarter gone by, but Phoenix looks like an interesting one. Nesco could be a fairly interesting one. You know, I think with the entire business district that's even Suntech is planning to put up in that part of Bombay, I think, you know, and incrementally there is some talk about the auto show, which has predominantly been in Pragati Maidan in Delhi, probably moving to Nesco. So I think retail and commercial could be relatively better placed, even from a yield perspective. And I think, you know, if you want to play it as a proxy, you could even look at playing it through REITs, right? So whether you look at Embassy or a Mindspace. So I think that looks like an interesting space, but not. I don't know if this run in real estate on the residential side can continue unabated.
Okay, all right. We'll leave it there. Rahul, great conversation as always. Thank you
so
very much for joining us. It's a pleasure speaking to you. The market.